Hello, my name is James Noel, and today I'm going to explain about corporate governance and risk analysis of Sapura Energy Period. So let's start. Okay. The background of Sapura Energy Period is the name was actually called Vadritz Energy Period, and then it's changed to formally say Sapura Energy Period. It's the only largest Malaysian integrated oil and gas service company besides oil and gas. They're actually doing engineering and construction services, offshore drilling, and also they actually operate and maintain. So what are the challenges that are facing this company? First of all, the high level of debt. They are borrowing a lot of money comparing to the regenerate the profit, and also project problems, decline of oil prices due to the war between the countries, strong industry competitions. There's a lot of companies which are actually competing with Sapura, and also financial distress due to the PN17 status. So Sapura, you can see here that it's actually having the big problem of debt, and also big problem of competition. Besides that, they have low performance in their projects. So what are their recoverment action or recovery actions? Sapura actually reduced borrowing money from 10 billion to 5 billion, and also improved the governance and risk management practices. They actually did, but still they have a large debt that they need to actually consider. Okay. Business and inherent risk assessment. Sapura actually having the business risk and also inherent risk. Inherent risk is actually made the risk of material mismanagement before considering the internal control. I can say it's actually the transactional deals, some transactional problems, human error problems, the internal things. Business risk is actually the event that may prevent the company to achieve their objective. I can say the factors that are affecting the company internally and externally. I can say that. So you can see there. So like Sapura, there's a lot of business risk and inherent risk that is affecting Sapura company. Due to that, we can just go ahead and see it. Okay. The first inherent risk is actually going concern and financial distress. Difficulties in financial due to their borrowing much money. Still, they have the problem of actually not having their own money, which is actually made Sapura to not be able to compete with other companies. Debt restriction risk. Debt is involving in complex accounting treatments. They have a lot of debts in which actually there's made the way that the company cannot be able to sustain itself in a good way. So that's it. But still, debt forgiveness is there, financial ability, disclosure requirement is actually there, but still they have debt problem and financial difficulties and distress. Additional for that, in inherent risk, long-term contracts, which actually they have a long-term contract which actually they do not perform well, which leads to them to have a higher project cost, and also leads to a lot of project fail, like Angola project actually failed, and also access impairing risk. They're actually doing the impairing testing, which is actually not good on that. Yeah, so here we can just see here there is they put more long-term contracts, but still they don't do nothing. Yeah. Business risk on the business risk, project exclusion risk, competition risk, liquidation risk, industrial dependence risk, large project delays, That's the risk of business risk. Competition, a lot of big companies are actually doing their best to put more effort on fighting the supporter company. Liquidation, no money inside the company. So they need to borrow money to pay their staff and whatever. Reputation risk is actually the name is actually being affected due to the fact that nobody wants again to put they don't have the confidence to invest anymore. So industrial risk, industrial dependence risk, they actually depend on oil prices, energy demand, and global economic conditions, which leads to this current situation whereby the oil price shoot down due to the war, when the supporter not get the money. Yeah. Corporate governance. So supported actually having the good corporate governance, like the board structure and the audit committee, but still they need to actually make sure they put more effort on putting a good people that they can control and lead the company. Okay. The weaknesses of the governance is actually they're unable to monitoring the borrowing, monitoring the large project. They are able to they are weak in identifying things, so lead to the supporter to lose some money. So they need to actually, people who are actually being employed governing the supporter company, they should be able to monitoring and covering the loopholes that are actually in supporter, so that the supporter can actually be able to grow and be better and be actually focusing on the big companies, big profits, and also be able to compete with other people, big companies. So it's all about that for today. Thank you so much.
Greeting. So now I will presenting the audit branding metrics. As external auditors, we design a risk-oriented audit branding matrix targeting key financial risk area and corresponding procedures. Audit area key audit procedure going concern review cash flow forecast, test key assumptions against market trends, and inspect bank loan agreement for debt covenants compliance. Debt restructuring inspect debt statement agreement, confirm direct debt forgiveness entries with ledgers, and verify compliance with MFRS accounting standard. Revenue recognition test percentage of completion calculations for long-term consumption contracts and re-performs cost to complete estimations. Asset impairments evaluates independent asset valuations reports for rigs and offshore equipment, verifying carrying values against recoverable amounts. Receivables and provisions sets direct debts confirmations and reviews allowance for aspects for expected credit losses on slow playing balance. So moving on to the audit procedures. To ensure comprehensive coverage beyond standard balance sheet testing, our audit plan incorporates 5 extensive audit procedures under ISA 330. First, we apply data analytics to perform high-risk journal entries testing to identify potential management override of balance sheet adjustment. Second, we evaluate internal controls over procurements and bidding to confirm that revised authorizations limits are actively enforced. Third, we conduct a dedicated reviews of related party transactions to ensure arm's length commercial terms and proper MFRS 124 disclosure. Fourth, Given historical ledger exposures, we send direct confirmations request to the external ledgers console to assess active arbitrations and contingent liability disclosures. Finally, we perform extensive subsequent events testing up to the report sign off dates to capture post-period developments that could impact going concern assumption. To conclude our analysis, when Trees Energy financial trajectory serves as a crucial case study in corporate governance and risk management. The server finance distress that led to PN17 status was not merely a result of industry downturns, but was heavily compounded by our over-leveraged balance sheet, poor risk identifications, and cost overseas projects delays. While the successful FY final year 2026 debt restructuring exercise significantly restores balance sheet stability by cutting debt in half. Financial health remains fragile. The management shift towards staggered project approval limits and focusing on core regional markets in Southeast Asia is a promising step towards sustained operational recovery. However, from an external audit perspective, the residual inherent risks surrounding going concern, revenue estimations and asset valuation remain especially high. Strict adherence to robust audit procedures and maintaining professional skepticism are vital to ensuring financial transparency and when Trace Energy works to rebuild investor confidence and SZPN 17 status. That's all for our presentations. Thank you.